Hey, Bowtie Nation, Joseph Hogue here. Just reading some of the comments coming in the chat there. Love it. A couple people wondering if there are any humans here. Got a couple of dogs watching, so I love that. I love my four-legged friends here. But thank you for being here for another Beer Money Sunday. Just a great opportunity to connect back and forth, face to face, more than our regular videos, and I love it. I love the interaction we get. So thank you for being here. Grab your favorite beverage, adult beverage or otherwise, and we're gonna get started because a really interesting kind of pros and cons of the stock market for you today. You know, those of you in the nation, you know that I've been kind of on the overvalued and watch out for that crash kind of camp. A lot of YouTubers have been, a lot of the old school analysts have been. But there is another side to it, another side that says, and that I'm kind of coming around to, because another side that says, okay, there are a lot of other factors that are holding up this market, will continue to hold up the market, and and could mean that even if we do get some kind of a sell-off, and I'm going to show you everything behind this and how I'm using it to trade and how I'm using it to invest. But even if we do get some kind of a sell-off, it's going to be fairly short and actually just a buying opportunity. So more like a correction than a stock market crash. And I'm really excited to bring you some of the data and some of the things that I've been looking at over the week. But again, thank you for being here. I see everybody in here for Israel, London. You know, thank you. It's awesome seeing everybody from all over the world around here. So we're going to get started. Because there have been just some crazy valuations in the market over the past year, really. One of the biggest questions I get on the channel is, why is the stock market not reflecting kind of the weakness in the economy? Okay, so, and one of the first things I want to do is show you this chart. This is from Advisor Perspectives, and so just look at this chart of the PE ratios, right? And this is laid out a little bit differently than what you're probably used to seeing. This is on number of standard deviations from the mean. So if you look at the PE ratio, right now it's about 22 times forward earnings, a little bit higher, maybe about 25 times trailing earnings, which you have to go back to 2000 to find prices this high, okay, relative to earnings. Looking at it on a standard deviation basis, which you stats nerds like myself, you know that 2 standard deviations, which is where it's trading at now, is extremely high. Okay, so measuring stocks or the stock market on this perspective, stocks are undeniably expensive. Okay, you look at this and stocks have only been this expensive on that standard deviation basis, twice, 2 other times in the past 140 years, okay, back to 1880. So, and both those times, so look, 1930 and then the year 2000, the other 2 times stocks were this expensive on that standard deviation basis for the PE ratio, and we know what happened at both of those instances. So definitely a lot of people out there talking about a stock market crash, calling for a stock market crash here in the next year or soon. But then there's the other side of the story that we're going to talk about today. We're going to talk about the pent-up demand that everyone is talking about. We're going to talk about kind of where the market consensus is going and how you should be contrarian in some of that. And then I'm going to share my strategies with you and kind of how to play that. Okay, strategies where you're going to be able to use them. And even if we're not exactly 100% right, even if we can't time the market perfectly, because nobody can, they're still going to make you money. They're going to protect your downside, and and they're still going to be able to give those positive returns in 2021, no matter what happens. First, though, I want to, and then of course we'll have a question and answer session in the towards the end there. What I'm going to do with today's video, like I've been doing in the past, I'm going to chop it up after the live stream. We're going to have this first section here first as a separate video, and then I'll publish the Q&A portion afterwards as a separate video as well, if you want to check out all the questions that we looked at. But first, I want to make an announcement. This is really cool. This is something I've been trying to do for a while now, been putting together the daily bow tie. Okay, this is going to be our daily market update newsletter. I'm rolling it out in January 4th, and I've got a link in the chat there. I'm gonna put the link in the description as well as in the first comment below if you want to sign up. It's always going to be totally free, forever free. I'm not going to tell you that I don't do sponsorships and affiliates and everything in my business. Just to make, I got to make money, got to pay the bills. But this is something that I've been wanting to do for a long time for you out there in the nation. It's totally free basis and never charge for it. Okay. So what this is going to be, this is going to be a daily market update. Going to send it directly to your inbox after you sign up. And it's going to cover a lot of great stuff. We're going to cover the market, what the market did the previous day, kind of some of the trends and the forces in the market. I'll show you the top sectors in the market and why those sectors are benefiting, why they're going up. We'll look at some of the top stocks. Each newsletter, we're going to look at the top 3 stocks, why they're going up, whether it's a particular stock or maybe a larger trend and that entire sector. And then I'll give you all the market news there. So just a great market update every day before the market opens. Actually, I'm going to probably pull our Facebook group there, and I'll ask you in the community tab, if you want that the night before, so maybe like 9 p.m. the night before or early in the morning before the market opens. But that'll go out every day. Look for the link there in the chat or in the video description, or you can just go to, you see here, mystockmarketbasics.com/dailybowtie, and that's going to take you to the sign up page. Again, all totally free. I'll never be charging for this. It's just something that I've been wanting to do for a long time for all you out there in the nation. So let's get into it though. Last week's videos has some great videos on penny stocks that have become instantly popular. I know all you love those penny stock ideas, so check that out. That was Friday's video. This week we've got special holiday week coming out for you, wrapping up some of our 2021 picks with real estate stocks, so REITs, some of the best stocks overall that I'm looking at, as well as some tech stocks coming out at you on Friday. I think that's Christmas, so a little bit of a Christmas gift video there for you, the best tech stocks to buy for 2021. So now I want to get started, and I want to get into this topic because, like I said, a lot of you know that I've been waiting for a pullback in the market, and a lot of people have been calling for that crash just because the market just is not reflecting the greater economy. And that's not saying that it necessarily has to. The market is always forward looking. Okay, the stock market, between all the investors placing their bets in the stock market, it's supposed to provide a picture of where the economy, where everything's going to be, 6 to 12 months in the future. Okay, people are betting on those future earnings, right? And so that's why we say that the stock market is a forward predicting market. So it doesn't necessarily have to look like the economy does today, but over the long run, they have to match up, right? The economy drives those corporate earnings, and those corporate earnings drive stock prices. So over the long run, they're going to have to match up. And when they get out of whack like this, or like we've seen in the past, something has to come to bring them closer together. So that's really what we're going to look at today: is which is going to give first. Which is going to give first? The stock market prices, are those going to come down to meet the economy if the economy doesn't, if expectations don't come in where they're expected? Or maybe the economy will come up. People talking about this pent-up demand and some of the data points and some of the stuff we'll look at today. If that does come up and fulfill those expectations, we could get another record year just like we had this year. So, I mean, looking at the general economy now, a lot of people have been talking about, okay, unemployment. These are continued claims, right? So every week the BLS publishes new claims for unemployment, right? And those over the past 2 weeks have been surprising on the upside. About 845,000 people have filed for new unemployment each week over the past couple of weeks as the new virus, cases surge here in the U.S. as well as some spots there in Europe. But that's kind of a volatile number because it's just week to week. What I look at is the continued claims, which is kind of a 4-week average of that. No, I'm sorry. The continued claims is the people continuing to draw unemployment, right? The average number is something else that you can look at. But this continued claims, 5.5 million people, and that's not including a lot of the people, the unemployed, that have fallen off of unemployment because they've been unemployed since March. So high unemployment relative to where we have been in the past. And I think, we could see another wave of retail bankruptcies as we get into this first quarter here. Okay, so over the next 3 months, a lot of retailers, a lot of stores are going to be talking about, how the holiday season didn't necessarily save them like it does every year. Okay, they call it Black Friday because it's traditionally the day that retailers go in the black on their accounts, right? They go profitable on their accounts. Just, the holiday shopping is so important for them. And yes, we've seen holiday online sales up about 20% this year from 2019. But we've also seen those traditional brick and mortar sales down 20 and 30% and more. Okay, so any retailer that doesn't have that strong online presence, they're going to be looking at the next 3 months and saying, okay, you know what? How much longer can we go at this? We're just bleeding cash flow, and there are going to be a lot of retail bankruptcies here in this first quarter. Not only are retailers going to going to get over that holiday season. Okay, nobody's filing bankruptcy now because they're still making money. There's still people holiday shopping and spending. But get that first quarter. There's going to be buyers for the liquidation sales. There's going to be the markets are higher and spending is up. So there's going to be people out there. Another thing that we have to look at is the potential for a rental and a mortgage crisis, really bleeding into a real estate crisis. Okay, another commonly stated data point here is the fact that up to 14 million people are behind on their rent. And an average of like $5,000 behind on their rent, right? And so these moratoriums to evictions and to foreclosures roll off, I believe, the end of January, and have already kind of started rolling off in some states. So what happens is, what happens when all these people are confronted with, a bill, back rent due of $5,000-$6,000? They're just going to move. Okay. I've been renting single family houses for upwards of about 20 years now, and confronted with that kind of a question. Most people are just going to move, okay? And yeah, they got to move somewhere, so they're going to rent some of those vacant properties that get vacant, but it's still going to mean higher maintenance. If you've ever rented a property, half the time you just pulling up the dump truck, and just putting all the trash and the shit that they leave behind in it. So it's going to mean maintenance costs. It's going to mean a renovation costs for all these landlords, especially the larger REITs, apartment REITs that I'm looking at. So that's an overhang, and a lot of people are saying, okay, is this going to spill over into a larger real estate crisis that is obviously going to spill over into into the rest of the market and the rest of the economy. So that's kind of the downside, the bear side that a lot of people are looking at and saying, how can stocks be this expensive? Okay, how can that PE ratio be the highest it's been since 2000, and before that since 1930? But there are some very strong, bull cases for the market. One of the biggest ones, and one you've probably heard all about. Let me see if I can find the graphic for you here. The personal savings rate. Okay, and this is the Fed measures, how much people are saving of their disposable income, right? And they put this chart out. They update this monthly. And this is the personal savings rate. You see here in October, the most recent point that we have, 13.6%. Okay, so that means on average, households in the United States are saving 13.6% of their disposable income. And you look at it and you're saying, well, shit, 10 million plus people unemployed, a lot of people, underemployed. How can that be? How can there be so much pent up demand in the system? Well, you got to understand, even 10 million plus people unemployed, that's still only about a 6% unemployment rate, 5% unemployment rate. So you've still got 95% of the population, of the workforce, that's still employed, and they're not really doing a whole lot, right? They're not going out to the malls to spend, and they're not going to the movies. So they're saving almost 14% of their income. And, if you look back here in the graphic, I mean, you have to go back to really back to before the 80s. Before you find a savings rate like that, back in the 50s, 60s, 70s, and 80, 50s, 60s, and 70s, people used to save that money. I don't know why. I don't know why they didn't just spend it, but hey, we are back to a 14% savings rate, and in fact, Morgan, I believe it's Morgan Stanley. Yeah, Morgan Stanley estimates that that excess savings, beyond what we've been saving over the last couple of decades. Okay, so what savings habits people have built over the past decade? That was around 4 or 5%, right? That people used to save. That's an extra excess of $15 trillion. Okay, so that's the big impetus. That's this big pent up demand that everyone is talking about. That if that comes back into the market, when it comes back into the market, into the economy, then that's obviously going to lift earnings for companies, and by that lift share prices. We've also seen, okay, the Congress has just last night agreed on a stimulus bill of $900 billion. And that follows the 3 trillion that was released in March. So if you look at this, 3 trillion, about 4 trillion total. The economy is only $21 trillion total. Okay, so you're looking at about 20% of stimulus, of cash flow that's pushed into the economy, in the course of about a year. Okay, so yeah, even if unemployment is still very high, even if a lot of these retailers are looking at going under, if all these other points in the economy are flat or below last year's numbers, you can't just push 20% of the economy back into GDP and not expect asset prices to get inflated. The Fed has committed to not raising rates ahead of inflation, but to let it go over that 2% target. Right now, inflation, as the Federal Reserve measures it, is around 1.4, 1.5, right? That PCI inflation measure. And, Chair Powell came out Wednesday and he was dovish as always, saying that they weren't going to raise rates. They were going to do everything they could to help the markets. So we're looking at inflation right now, expectations of 1.4, 1.5%. They're saying they're going to let it go over 2% before they even think about raising rates. And one of the arguments here, another argument for the stocks at this point is that low rate argument. Okay, and this is just that with rates basically near zero for bonds, even for corporate bonds, even for money market accounts. Rates are pretty much near zero. That pushes everyone else into those riskier assets for yield, for return. Okay, insurance companies, they have to invest their money. They have to invest that cash they have set aside to pay those premiums. Okay. They can't just sit on the sidelines. So they have to push all that cash. If they're not making interest rates, they're not making a return on those corporate bonds, on those safe bonds, those safe money market accounts, they have to go in further into stocks and further into other riskier investments. So that's basically this low rate argument. The fact that you can't look at the price to earnings ratio in the past, which was averaging right around 15 to 18 times on a price to earnings basis. You can't look at that. Look at today's price to earnings ratio of 20, 22, 23, 25 and say that stocks are expensive now because the interest rates are completely different. Okay, in the past, we've had interest rates right around 4, 5, 6%. Okay, and you can't compare that with interest rates now that are 0%. Basically, for all intents and purposes, zero interest rates. So that's another argument. We've got an incoming Treasury Secretary, Chair Yellen, that actually was the chair before Chair Powell. She is extremely dovish. I guarantee you, Biden picked her because she is dovish and because of her experience as the Fed Reserve Chairman or the chairperson. And she's going to be just as dovish. Okay, she's coming into Treasury and she's going to figure out all the ways she can to help pump money into the system. Along with the Fed. So some very supportive arguments for the stock market. But now let's put this together and look at kind of an investor's view of 2021. Which side is going to win out here? Are stocks expensive? Will there be a crash? And what to do about it? And that's really the tricky part because just as the just as the market started its meteoric rise, right, when there really wasn't much hope. The market started rising. March 23rd was the low, okay? And we were still hitting, thousands of people, tens of thousands of new cases a day, no hope for a vaccine in sight, a lot of that, and the market starts rising, okay? So again, there is so much enthusiasm and so much support for this market, so much sentiment support for this market that I think it can keep going. It's basically the market looking out even further than 6 months, looking out to that $15 trillion in excess savings that's on the sidelines that can come into the economy and then into earnings and into valuations. So, two things. I think you can really look at the market and have a positive outlook for it. The Fed, they always say don't fight the Fed, right? Because it does control those interest rates, and they're not budging from the interest rates, right? You also look at weakness in the U.S. dollar. Okay, the dollar is down about 15% over the past few months. And basically, that's just saying that, okay, if you've got a weaker currency, a weaker dollar, that means all those the manufacturers, the U.S. manufacturers, the exporters, they're going to be shipping more product out of the country, out of the U.S. because it's now less expensive compared to those other currencies, right? So that's going to help support growth. It's going to be great for commodity investors. Commodity oil investors have seen oil go from $35 a barrel up to almost $50 a barrel, and a lot of that is on that weaker dollar. Okay, so we take both of those the pro and the con side. Now, the way I'm playing this and what I'm thinking about here is I still wouldn't rule out a small correction maybe in the first half of 2021. And actually, I've got a short-term investments video that shares 7 short-term investments I'm playing here. That's going to be releasing the first week of January. But one of those is the idea of a straddle, an options trade straddle, right? And a straddle is where you buy the puts and the calls, at the same strike price on a stock or an index. And in this case, we'd be using the SPY, right? The S&P 500 index ETF, the SPY. We'd buy puts and calls. A put gives you the right to sell a stock. A call gives you the right to buy a stock, right? So what I'm looking at, we'd do that for January 2022 expiration, and what I'm thinking here is stocks are undeniably expensive compared to the past, and given some of these other economic hurdles, right? Just this weekend we heard the UK, Britain, they announced a new mutation of the COVID virus, and this isn't the first mutation that's been discovered. There have been others in Europe that they've discovered, but this one it's faster transmission than the other mutation of the virus than the main virus. I think the researchers there in London have estimated that upwards of 60% of this new virus surge there in Britain is because of this new form of the virus, right? So, in effect, also over the weekend, Europe closed down flights from Britain to keep it from spreading further, to keep that new virus mutation from spreading there. And if we do get some kind of news like that, where it's discovered that the COVID is mutating into other forms of the virus, and they're either not quite as weak to the vaccine, they're not quite as susceptible to the antibodies that the vaccine builds, then that would obviously be tragic. But also, if we just see that the coronavirus is going to be like the seasonal flu. If we find out that this thing is going to come back every winter, just like the seasonal flu, then yeah, we have time to build a vaccine each year against that new annual mutation that we get. But it is 10 times more transmissible than the normal flu. So that means we're going to be going through something, every winter, something like this. So that would obviously be something that would cause a correction in the market. We've also got, I think, with this new stimulus package, a lot of the states, a lot of the health services in the states are going to be looking at this and saying, okay, you know what, we've got the health, we've got the stimulus checks coming. That was announced last night with the package. We've got all this other stimulus. We can start to announce these, lockdowns again. We can say, okay, people can be laid off a little bit more. They're not quite, the economy isn't quite in as much danger because we've got this new stimulus coming out. So we're going to lock down a little bit more. So I would expect this week, after that stimulus is passed, then more states to start saying, okay, you know what, we're going to lock down for the next 2 or 3 weeks just to fight this recent surge. That could also, cause a small correction in the market. But what I'm looking at here is, again, you've got those support, that data for support in the system. You've got the 15 trillion in excess savings that's waiting, waiting on the sidelines, that's waiting in households to be spent. You've got, obviously, yes, the vaccine is being rolled out, and they're expecting upwards of 100 million people in the U.S. alone to be vaccinated by late spring. That would be about 30% of the population. If we're already at about 30% of the population that has had the virus since then, that would get us right around that 60%, 60 to 70% herd immunity that we need to get at, to where, the virus starts dying out naturally, in the population. So we could be back to some kind of life as normal by summer of next year. And of course, that would bring in that pent up demand for money. That would bring in the investor sentiment. So what I'm thinking here is, while we may get a small correction in the first half, and again, a correction is any loss of 10%, 10 to 20% in the market, okay, from the peaks. Okay, so for the S&P 500, it was recently right around 3,700, so that would be 370 down. That would be, right around 3,300 for the S&P 500. Right around there, between that and 2,900. Okay, so it would be, a sizable correction. It would be painful if you're overextended, if you're leveraged, if you're investing on margin. But it's not going to be something that's going to turn into a full-blown market crash, I don't think. And that's really the reasoning I'm using for the video. I don't think there's going to be a full market crash in 2021, because you're going to have the market forward looking into, all that support that we've got coming, right? The excess savings and everything else. So my idea on that straddle investment that I kind of went off track on, that straddle strategy, is that if you're buying the puts and the calls of something, of the SPY, of the index, then you're going to make money on the puts if we get that correction, right? If we get the S&P coming down that 10, maybe 15% at the most. So what you can do is, you've got the puts and the calls. The puts become in the money, and you're profitable on those. You can sell those out, February, March, whenever that first half correction comes, and then just keep your calls. Okay, the calls are going to be losing money at that point, but then again, if we do get that turnaround into the second half, then I think you can start making money on the calls as well. So it's kind of a great strategy to play a really kind of a bipolar year, and I think that's what we're going to get next year. Is kind of a bipolar year from the first half and the second half. Conversely, if the first half turns out to be great, if stocks keep rising into the first half, looking forward into into the second half, into that excess savings and stuff, I do think the odds of a larger correction just amplifies in that second half, just because you can't the market can't keep going higher forever. It's going to get a catalyst that is going to send the market down lower. Now, before we get to our question and answer, I want to just cover some real quick sectors that I'm looking at to play on this theme. Energy is still expected to perform well, to do well. It's right now, I think analysts are expecting about a 10% return on energy through the year, and that's actually down from 46% they were expecting about 2 months ago. And because the energy market, energy stocks have gone up like 30% in the last month, so a lot of that has been taken out of there already. I still do like energy though. We're in FANG, so Diamondback Energy, ticker FANG, in our 2021 portfolio still. I have cut our exposure to Reggie, so renewables energy, and to Devon Energy, just to cut our exposure a little bit to energy after that monstrous run. We're up like 54% on these stocks, so I wanted to take some profits on those. I also like healthcare and financials as well, and a lot of you, everyone there in the nation, knows that I've been watching the financials. They're in our portfolio for a while, just because I think we do get a rollback of some of those loan loss provisions that the banks have been the banks have been reporting over the last few quarters. So those will do really well. I think healthcare will do really well. And again, it's not that 2020 hasn't been about healthcare, but it's been about the wrong type of healthcare, right? Hospitals, healthcare services have had to scale back and postpone and cancel all those high margin, services, those highly profitable services, the elective surgeries. So they haven't made any money, right? So healthcare stocks have come down quite a bit and fairly quickly. But into 2020, 2021, as those services, those margin services come back, then one, obviously the earnings are going to go higher. But two, it's just going to be a very easy comparable. Okay, if you look at these healthcare service companies, these hospitals and otherwise, medical devices, things like that, they're going to be reporting earnings that 20 or 30% earnings increase year over year, okay? Because earnings were so bad in 2020, it's just going to make the 2021 earnings look so much better. Investor sentiment is going to rebound, and I think you're going to make some money there. I would also be looking at travel and tourism, but more of as a trade rather than a long-term investment. Okay, a lot of these travel and tourism companies have put on billions of dollars in debt just to stay alive here in this last year. So I do think, as we get closer back to normal, and that $15 trillion in excess savings starts coming back into the economy, these stocks can do very well. These hotel stocks, travel stocks, airlines, things like that. But over the long term, I would be much more hesitant to make them a long-term investment, because they're going to have those interest payments that are just going to be piling up, and I think it's going to be really hard for them to service that debt. So I've seen some really great questions here.